Gotta bring the microphone into play. Hi, what do you want? I don't have anything else. See? Here, look. All right. Friends, how you doing? It is Thursday, November 12th, and this is the second installment in construction and analysis of a double diagonal option strategy. In the first installment, I really just talked about the high-level rationale of calendars and diagonals, volatility, skew, volatility skew, the contango and backwardation that exists within volatility, the different volatility regimes, where you might put in a credit spread as opposed to a calendar. I'll do a little bit of a review of that. But generally, a diagonal or a double diagonal or a calendar or a double calendar is just basically made up of spreads. Spreads being two legs, two option legs, two specific option contracts that have different expiration dates. And typically you go short the near term contract and long the further out contract. And you can have two different types. You can have put calendar or diagonal spreads and call calendar or diagonal spreads. The difference between a diagonal and a calendar, other than the fact that they have two legs and different expiration dates, is that a calendar has one strike price in common between the two legs, and a diagonal has different strike prices in common between the two legs. Now, the reason why we put on calendars or diagonals as opposed to a credit spread is mostly because of the way they would collect premium. And what we're looking for is a skew in the near dated month versus the long dated month. We would like to see a backwardation happen, or some kind of difference, or very little change in volatility. You see, a credit spread is optimized when you can buy it with a lot of premium and high volatility, and then it works with you as volatility drops. A calendar and a diagonal spread are the opposite. They work very well when there's very little volatility or not any movement at all. Works against you if it goes down, but works with you as volatility rises. So you can see now we have two different things. One that works better in higher volatility regimes, and another that works better in lower volatility regimes. So I'm using that word regime. Where is that regime? And it's kind of arbitrary, but in general, where is that Mason-Dixon line that separates high volatility from low volatility? That really depends on the times, where you are in history, what has been the normal level of volatility over the past 3 months, 1 year, 5 years. Over the past 5 or 10 years, volatility has been very, very, very low. And so it may seem to some that anything above 20 is a super high volatility, and we are in fact right around 20 right now on the VIX, the measure of this sort of relative volatility. But historically, mid-range volatility or normal volatility has been somewhere between 15 and 25. Now, I think that has been lowered now to something closer to, I don't know, 12 to 22 as being more normal. So you could consider anything on the lower end of that range low, and on the upper end of that range kind of closing in on normal and getting to the point where it's going higher. High volatility is usually considered something above, say, 30, 32. So the regime, in my view, the area of demarcation, and it's not a clear-cut area of demarcation where you start switching from credit spreads to calendars or diagonals. It's a spectrum. And in fact, even in low volatility regimes, there may be times where a credit spread might be useful, but dramatically less than when it's in higher volatility regimes. That regime, I believe, is defined by maybe a band somewhere between, say, 27 and 32 on the VIX. Just ate something, got stuck in my throat. I don't have the corona. So that's where I start looking at the change. I'm solidly credit spreads right down through to the high 20s. And then as we get below that, start looking at calendar spreads. And of course, it also depends on the rate of change of volatility too. If it's just dropping dramatically, then it makes sense to keep on with the credit spreads because you want to take advantage of that drop in volatility and age your position. So just because it crosses the line doesn't mean that you make a switch over. Like I said, it's a spectrum. Depends on location and velocity. So right now, volatility has dropped dramatically over the past couple of weeks, week and a half, particularly after the election. We're starting to kind of level off. And I don't anticipate that volatility will go down much further in the near future, particularly when you consider all of the political strife that's going on and the contention for the presidency of the United States. A lot of you might think that it's going to be Biden. Some people are hopeful for Trump. I personally think that Trump is going to win out, and they're going to find out that Biden and the whole Democratic Party are frauds. And he's going to win either by recount or by fiat of the Supreme Court. So that, I believe, is going to inject a great deal of volatility into the market. You can probably expect the leftists, once this happens, that they'll start rioting, and that may disrupt markets. So I do think if it goes further in the way it is going, I think that you're going to start seeing some fighting in the streets again. They may have nobody to fight. I doubt that conservatives are going to get out there and start fighting, with them. Let them just do whatever they do. But we'll see. We'll see what happens. I believe that's going to inject some volatility. Recently, we had, on this past Monday, we had an announcement from Pfizer that they had completed a phase of their drug trials on a vaccine for the corona. And that news shot the market up temporarily, but now it seems like we're fading that move up. And so with that fade, volatility is starting to sort of settle in. So right now, while the velocity has started to slow, we're still coming down a bit. I still look at it as predominant credit spreads, but now we're switching over to diagonals and calendars. Because in the event of a sharp spike in volatility, and we get a backwardation situation where our front months start becoming more rich in premium than our further out months, this is the perfect environment for a calendar or a diagonal to profit more quickly. And that's really the key. That's what everything comes down to. It all comes down to you know, how efficient can I make the use of my money and in these positions? So a credit spread where volatility is coming down is far more efficient because we're taking advantage of the overstatement of volatility, implied volatility, and now regressing back to its normal state. As opposed to calendar spreads, which are doing exactly the opposite. We're hoping for that difference in regression to favor staying steady or moving up. So those are the underlying reasons why you would choose one over the other. The interesting part about trading with two different expirations is that when you start doing an analysis and look at the profit and loss or risk diagram that comes in most trading platforms where you trade options, it looks very different from just a straight credit spread that has legs with the same expiration. It's easier to figure out what your profit and loss are, what your max loss, what your max profit are, where the break-even points are, because they are fixed relative to each other. They're at the same volatility because they're at the same strike level. Whereas a calendar is different, and so it's continually varying. You can get a general idea of your max profit and your break-evens, but the actual T0, or the time at that moment of premium, is really something very difficult to determine. And it can change over time. You can get a collapse in volatility and the whole thing kind of comes down. You don't want volatility to go down while you're in one of these trades. You want it to stay steady and let time work in your favor. And that's what we're really looking for. We're looking for time to work in our favor. Now, all of this sounds like super complex, but it really isn't. If you just boil it down to, what you want to trade and what volatility regime that you're in, then you're good. All of these theta collection strategies are in your favor because you can make very efficient use of capital, and you just have to worry about time. And price movement is kind of taken out of the equation. And of course, all of it depends on the skill that you have in constructing one of these, how much price movement you take out of the equation. Your ultimate goal is to get as close to delta neutral, or a delta that is as close to zero as possible, and maximize your theta, which is your premium collection. So you want to be in a situation where you don't care where price is going and money is still coming in. That's ultimately our goal. And at Asymmetric Options, the Asymmetric Advisor, this is what we do. In the service, we simplify this for everybody and make it very easy for them to make a choice. And we show them, where we are, what type of strategies that we prefer, how we're being efficient with our capital, what type of return that we can expect, what kind of risk that we're going to take. And with that, we're able to carve out, so far, on average, about 8% per month. Sometimes more, sometimes less. But we have been consistently beating the market. And with very, very little volatility in the returns. So, in other words, we don't take huge risks where you have big swings up and big swings down. We take small little risks and just incrementally add to our equity. And so our equity curve has very few drawdowns, and the ones that we have are very small. As a matter of fact, our max drawdown to date is about 4.4%. And that's remarkable when you consider that, at an annualized return of over 100%. So and that's a comfortable way to trade. You want to be in a situation where you're trading with very little ups and downs, and you feel confident. You have good control of your risk, and you can make sound decisions. So again, this is the second installment of the diagonal. I said that talked a little bit about diagonals and calendars in general, but now, and I also talked about keeping things delta neutral. One of the drawbacks of a calendar or a diagonal is that it doesn't have a very wide range of prices where you can stay delta neutral. So that can be a problem. Of course, the shorter the time frame, the easier it is to stay within that range. We like to put trades on that are somewhere between a few days and a few weeks. So say between 3 to 5 days up to 3 weeks. So we have to choose strategies that will give us a relatively flat profit curve over that area, but steep enough so that, and directed enough so that we'll have the theta growth. And you start looking at the shapes of these things that are super flat just aren't going to be moving up very fast. But things that are more rounded like this will move up faster. Now, there are ways that you can give yourself that opportunity. And one of the best ways is, first of all, you can widen your your effective range by putting on multiple calendars or multiple diagonals. You can start with 2. I always start with 1, see where it's going to take me, and then add another. Once I've added the second, I've extended my range, and now it's given me plenty of time to go either further down or regress back to where I was. So that's one of the big advantages of diagonals and calendars, is this ability to be able to adjust your trade, continually adjust it with relatively low cost, a great return on the capital that you use. And some people say, well, it's kind of like faking it until you make it, right? And it really is. Now, each adjustment costs a little bit sometimes. Sometimes you can actually put it in your favor. And in fact, that's what we do. We wait until we're in a situation where we can make an adjustment that is actually in our favor, that doesn't cost us anything, and in many cases is locking in profit and then bringing in more credit. And at the same time, widening our probability of profit. I know, it sounds weird, especially if you're a stock trader or a forex trader or a futures trader, which you have no ability, zero ability to do this, unless you're trading options on that asset type. So that's what we do here at Asymmetric Advisor. If you're interested and you're wondering, well, why should I go with you guys? Why should you trust Ernie? What's Ernie got to offer? He's probably just like one of those scammers, all the other scammers that are out there. Well, I'm going to give you 2 ways that you can differentiate what we do from what everybody else does. The first is that I publish my brokerage statement. Anybody can go in and verify my profit and loss by looking at my broker statements. I post every single one of my trades with screenshots, timestamps, everything, with a reputable broker. That's the other key. I work with TD Ameritrade. We have great performance, and it's proven, and it's there for you to examine. So that's one way. And that's really the principal thing, is that complete transparency that is unheard of in any of the services that are out there. I can name 2 others, and I would be happy to recommend those if they are right for you. But there are hundreds of others, and none of them do it. And that's because they're all frauds. They're afraid to show you their P&L. They're afraid to show you their actual broker statement. It's because what they profess is a lie. Now, I'm not going to go out and do any kind of reviews of these sites. There are other people that are doing good jobs at that and pointing out their fallacy. But I'm telling you, with our service, you are getting complete transparency and only the truth. The reason why the others don't show you their brokerage account, show you their trades, is because they're lying to you. Everything that they show you, their lifestyle, everything that they do, no matter how good it sounds to you, is a lie. We don't lie here. We are completely open and transparent. The other way that we differentiate ourselves is with, you get true coaching and mentorship when you're in this service, and direct access to me at all times. Unlimited support, unwavering support, immediate support. This is without a doubt the best place for someone who's never traded options or has traded maybe stocks or options for a little while and is looking for a way. Because not only do you get the full transparency, support that is completely out there and immediate and live from an industry veteran who has been doing this for 40 years, but you get it at an unbelievable price. So all of that sounds too good to be true. All I can say is I guarantee it. Guarantee it 100%. Full transparency, great performance, the absolute best support at a price that nobody can touch. How can I do this? Well, first of all, I don't need to do this. I'm the CIO of a 9-figure fund. It's my job. This is a reflection of that, and it gives me something to do. I don't always have to do anything there, quite frankly. I have a lot of time on my hands, and I like to help people. I want to make people successful. So if you want to check it out, go to our website. It's right here. Go to the member link up top, and you can look at our brokerage statements and our performance, and then see it for yourself. Google Asymmetric Advisor, 2 words, and look at the reviews of real traders that are in our service. So anyways, that's that. If you're looking for a place where you can learn how to trade options, how to make a consistent income, be consistently profitable with a way to develop kind of a supreme level of confidence in what you're doing because you know why you're making money. All right. That's all I've got to say. Hopefully this was useful to you. Thank you very much for showing up, and we'll see you next video. Peace.